You can also put your stop above high number 3. As your stop loss size increases, your take profit target will have to increase proportionally as well. And the larger your take profit, the lower the chance that it will be hit. The general rule for the take profit target is that it needs to be at least 3 times as big as your stop. And that means you need to have the discipline to let price either hit the stop or the target. You cannot close the trade as soon as price goes into profit, as this type of thing will ruin your account in the long term. Some people talk about measuring movements to create targets, but that doesn't make any sense in my view. Another detail about the head and shoulders pattern is that the neckline might not always be horizontal. Sometimes it can be sloped to the upside or sloped to the downside. You have to be careful when that happens because you want to put your stop loss order above highs that confirm the power of sellers, meaning highs that precede lower lows. Next in line we have the reverse head and shoulders pattern, which works in a similar way to the standard head and shoulders. So the reverse version is a bullish reversal pattern, while the standard version is a bearish reversal pattern. The reverse head and shoulders pattern has the same configuration as the standard, but the pattern is upside down. We have a lower low followed by a higher low. The logic behind that is that sellers were able to create a low in number 3, but as they tried to create a lower low in number 5, they failed. The pattern is confirmed when price breaks above the neckline, which, as we already stated, can be horizontal or sloped, depending on where the previous highs and lows are located. The safer entry happens when price retraces back to the neckline after breaking above it, and the optimal and logical stop loss order is below number 5. That happens because as price breaks above the neckline, number 5 will become a confirmed demand zone, which will protect your stop loss order in most cases. Not always though. This confirmation of the demand zone might not happen if we are dealing with a reverse head and shoulders that has a downsloping neckline that is too steep. The target for the trade must be at least 3 times as big as the stop. You must maintain a risk reward like that if you want to survive trading in the long term, but that's a subject for another course. Next in line we have a bullish reversal pattern called double bottom, and as the name suggests, it's formed by 2 lows that sit in the same price level. It's a bullish reversal pattern, so price will be going down, and then a double bottom will appear to signal a reversal to the upside. The double bottom is confirmed when the breakout line that comes out of number 2 is broken to the upside. The logic behind this pattern lies once again in the simple mechanics of highs and lows in the chart. A double bottom means that there are 2 lows hitting the same level, and that means that the second low failed to go below the first one. This is a sign of weakness of the sellers because they were not able to surpass the last level they created themselves. If price is able to break above the high in between these 2 lows, it means that buyers are gaining power over the sellers. So not only did sellers fail to create a lower low, but buyers were able to break the last level where sellers came from. This breakout line is formed only by the high, but by using this logic, you can increase your chances of avoiding a stop loss. The target should be at least 3 times as big as the stop loss size. Once your stop and take profit targets are set, you should not move them at all. You need to wait for the market to either hit your stop or your target. Just like we have the double bottom as a bullish reversal pattern, we also have the double top as a bearish reversal pattern. This pattern is formed by 2 highs that sit in the same price level. It's a bearish reversal pattern, so price will be going up, and then a double top will appear to signal a reversal to the downside. The double top is confirmed when the breakout line that comes out of number 2 is broken to the downside. The logic behind this pattern lies once again in the simple mechanics of highs and lows in the chart. A double top means that there are 2 highs hitting the same level, and that means that the second high failed to go above the first one. This is a sign of weakness of the buyers because they were not able to surpass the last level they created themselves. If price is able to break below the low in between these 2 highs, it means that sellers are gaining power over the buyers. So not only did buyers fail to create a higher high, but sellers were able to break the last level where buyers came from. This breakout line is formed only by the low in between 2 highs, so it can only be a horizontal line. The ideal way to trade a double top pattern is to wait for price to break below the line and come back to retest it as resistance. Just like we saw previously, as price retraces back to the breakout line, You should watch and observe if price reacts to the line. If it does, that's a moment to enter a short trade with a stop above number 1 and number 3. That's the logical stop loss order because as price breaks below the line, it confirms a supply zone in high number 3. So that zone will work as a cushion of protection for your stop. It doesn't always work, of course, but by using this logic, you can increase your chances of avoiding a stop loss. The target should be at least 3 times as big as the stop loss size. Once your stop and take profit targets are set, you should not move them at all. You need to wait for the market to either hit your stop or your target. There are traders that don't wait for price to retrace back to the breakout line, but as it was stated before, this can be a little riskier because your stop loss size will be bigger since you'll be entering in a worse position. Traders do this when they are afraid of missing the opportunity, so they sacrifice their entry a little bit, or sometimes a lot, just to be part of the trade. However, over the long run, acting like this will be bad for your equity curve. The next reversal pattern we are going to study is in some sense a logical extension of the double bottom, and it's called triple bottom. It's a bullish reversal pattern, meaning that price will be going down, and then the triple bottom will appear to signal a reversal to the upside. I said it's an extension of the double bottom because it's very similar to that pattern, but instead of 2 lows sitting in the same level, the triple bottom has 3 lows sitting in the same price level. In other words, lows 1,